Two things I think really matter right now. Europe has been better, not just today, but really all week. I think that's a nice help to our markets. And second, we got trade deficit numbers that were much better than expected at 8:30 Eastern time. China's probably buying more soybeans from us, but that moved the futures up as well. Take a look at the sectors, and the leadership is the same today as it's been for a while now. And we're talking about semiconductors. What are we up? The estimates has got to be up 20% or so. It opened on the upside early on, down a little bit now. Retail's done well. Consumer discretionary has been a leadership group. Energy stocks, oil comfortably over $60. That's been a leader. Banks have not been a leader. They were up until the beginning of March, and all these concerns about interest rates, they're not. We've noted often in the last week about how horrible the regional banks are. Just take a look. All of them are down double digits in the month of March. Most of them are still up on the year. We had a great January and February overall, but these declines, particularly in the short-term rates, really kill the regional banks overall. But there are sectors of the financials that are doing very, very well. FinTech, for example, a name that we throw around a lot without having a lot of meaning, has been spectacular. You look at companies that are involved in any of the electronic and mobile payments, your Lending Tree, your First Data, Square, PayPal, Fiserv, that's an old name in electronic payments. They're all having spectacular years so far, and the year is only 3 months old. So it's really about electronic and mobile payments and much, much less about classic large banks that are out there. I know everybody's upset about the lower mortgage rates, but has anybody actually looked at their bond portfolios? Yes, there's ETFs for all of that these days, and it's pretty darn good. There's the Global X FinTech ETF. By the way, there's an ETF for that too. You want to own FinTech? There's the one to own right there. It's not that large, but you could see it's up 23% or so on the year. Meantime, let's just talk about your bond portfolios. I know everybody's upset about the lower interest rates, but everybody's making money if you own a bond portfolio. So there's the high yield ETF. It's up 6% so far this year. There's the biggest corporate bond ETF. That's LQD. That's up 5%. The TIPS, Treasury Inflation Protected Securities, that's up 3%. Even your lowly Treasury ETF, 7 to 10 years, that's up 2.2% on top of the yields that you're getting, of course. These are just price moves, not yields. So you throw that in with 12% increases in the S&P 500, you get a 60-40 stock bond portfolio. Hey, folks, you're doing pretty darn good. If you've got an average portfolio, 60% stocks, 40% bonds, you should be very happy in the first quarter. Finally, just the home builders are up. I know Jim mentioned this, but Stuart Miller talked about improving and stabilizing housing market. The orders were down, but better than expected, and that's the key. They want a normal spring housing season. The head of KB Home talked about improving market conditions. These are the magic words that everybody wanted. So it wasn't like the numbers were necessarily so good. It was the overall outlook. And, of course, there is an ETF for that as well, the ITB. That's up 17 or 18% so far this year, up 2%.